Hi everyone, let's discuss the concept of startup finance, which is a chapter in the SFM. Okay, this is again one of the theory chapter which is generally ignored by the students. Let's make it as interesting as possible. Let's go into it. First, the basics. Let's understand. For example, let's take the case of Zomato. It was earlier a startup, right, where it was a new model which is delivering food via online orders. That was quite a new model, right? Now we sit on our phones, just place an order, get our food delivered. It's again a startup model. The startup financing here would mean the initial infusion of money needed, which is needed to turn an idea into a reality. They thought of an idea of getting the food delivered via placing orders online, and now it is being implemented because they have adequate funds. But this involves a lot of risk because this is a new venture. The customers have to accept it, right? Acceptance of customer is really very important, and this risk will also include the risk of bankruptcy. They could either go at top high or it can be as low as possible, and this also could have a negative impact or a strained relationship impact with the family and the friends. And yeah. So the one of the way to speed up the success of the entrepreneurship is to speed up the initial operations to get the first order as quick as possible, and just you have to show the audience that your business is worth to invest. And some business can also be bootstrapped. This is like you are trying to get some personal finances and fund it, or you are trying to make some nominal sales with which you can fund it. Okay, that's known as bootstrapping. Starting. Okay, then you for getting any fund, you have to have a strong business plan. Only with a strong business plan, the lender will be convinced to provide funds to your business. There are few ways to get finance for a startup. Some may be innovative and some may not. Okay. First method is like personal financing. Personal financing is that you have some savings and you're going to invest in your new entrepreneurship. Okay. That's what personal financing would mean. Then, personal credit lines is like CIBIL scores. If you are having good CIBIL scores or good credit lines, then the banks will be eager to give you loans as much as possible, right? Then, family and friends, these are the ones who are near and dear, right? They believe us and they will give money. This, again, if the money is lost, may result in strained relationships. Then, peer-to-peer lending. This is, for example, let's have the case of jewelry businesses where the jewelry owners will exchange or will help the other ones by giving the jewelry in time of their need. Okay, and whenever they are able to repay back, they will repay the jewels back. Similarly, this in peer-to-peer lending, similar group of people will come together and they will lend money to each other so that they can support each other's businesses. Crowdfunding is like similar to mutual funds, okay, where small number of capital will be obtained from a large number of individuals, and those amount will be invested in a new business initiative. With the invent of social media, this crowdfunding is gaining a good and easy accessibility. Then microloans are small loans which are given to individuals at a lower rate of interest for new business ventures. Maybe this is a very small amount which with you can just start the business and you cannot continue the business for a long time. Vendor financing is a form of financing in which the company lends to money one of its customers so that he can buy the products from the customer itself. It's just like vendor financing is nothing but credit. Okay, giving goods on credit. It's nothing but giving goods on credit. Okay. Whenever you are giving goods and credit, you have to convince your supplier also to take on credit. Generally, the credit period will be 30 days, but it may also be extended to 45, 60, or 90 days. But it's sort of financing. The startups' major issues start to get the first order, right? Or even for us to start reading the first page of the book or starting reading as a first habit is the difficult task. Similarly, the startup it is the to find the first large order. So many company will not have an amount. Many startup will not have the funds to fulfill the first large order. That's why these purchase order financing companies, what they do is they advance the required amount directly to a supplier. They will not give the amount to the company or startup. They will give directly to a supplier, and supplier will supply the goods. Okay, upon the completion of the transaction, the required amount along with the interest or the profit or a charge on the profits will be transferred to the purchase order financing companies. Factoring account receivable. It's just like we have the factoring, right? What we do is it is given to a seller who has sold the goods and credit to fund is receivable till the amount is fully received. Happens is like we have sold some goods worth 100 rupees to some customer. We go to a bank and ask for discounting. He will give me 10 rupees and additional, I mean 90 rupees. Additional 10 rupees will be charges and the interest for waiting. Okay, that's known as factoring of account receivable. This is the ways with which funds can be raised. Let's revise once again: personal financing, personal credit lines, family and friends, peer-to-peer lending, crowdfunding, microloans, vendor financing, purchase order financing, factoring accounts receivable. And then we have pitch presentation. Like we do PPT, is exact the same way of PPT, but nothing but it will say the investor about the company which they are going to invest at startup and why they should invest in this particular company. This generally is short and brief presentation, it's up to 20 minutes. Okay, what are things that are to be in there in a presentation? First one is the introduction. What is the company is all about? Okay, why the company is being existent and who are they? Okay, what are they going to do? What are their vision, mission, and objectives? All these will be stated in the introduction. Team. Whenever you are going to introduce the company is just an artificial juridical person, right? You have to actually introduce the team. Those are the people who work behind the scenes. They are the reason for the success or failure of the particular company. So investors should be knowing on whom they are investing. Okay. Problem. The investors should be well aware of the problem which the company or a particular startup is going to solve, and the solution, how they are going to solve it. Okay, for example, let's see the same case of Zomato, where it was like they are going to solve this, and by via of GPS connections or via the direct connections with the customers and via online and the with the supplier, they will place an order. This is how the mechanism works. Or for example, it was a Flipkart. This was the first time it started e-commerce, and they started payment through credit card. Those were there, right? Cash on delivery. For initial days, they took cash on delivery. Later on, they bring the system of credit card, debit card. Later on, net banking, UPI payments. All those were developed. Okay, yeah. The fifth one is the marketing and sales. For any business to be successful, the first major factor is the market size, right? How much market share I'm able to capture. Market share of the product. It should be communicated. What I'm planning to for a startup, it will not be there, right? Actual market share will not be there. So what's the targeted market share and how I'm going to achieve that market share? Projections and milestones. Generally, we don't have any past financial data, so we have to give projections, and projections should be based on reasonable assumptions. And there are three basic documents. Like we all as accountants should, chartered accountants or accountants background, we should know that, right? It should. These are income statement, cash flow statement, and balance sheet. We just know what these means, right? Then competition. For every business, there should be competition. Without competition, nothing will be good to enjoy, right? Whenever something is we are getting us so easily, then that will not last forever. So competition makes us to make something which is new, unique, so that you can charge premium prices for it. Business model. Business model is nothing but the way with which a company is going to generate the revenue and how it's going to make its profit and how it's going to satisfy the expenses. Okay, it denotes as a wide term, it denotes all the aspects of business, which includes the purpose or the concepts or the target customers or the target suppliers or the rate of return of investment, what its trading practices, what is the organizational structure, what are the operational process, and so on. Okay. Say for example, I have a company A and company B. Both a company are engaged in renting of movies. Like prior to internet, both were making same amount of profits, everything. With the advent of internet, some company would have switched to it in a fast manner, and some may not. Right, the one which have switched in easier manner would have been earning huge profits. This is a case of Nokia, right? It wasn't able to switch to smartphones in a good manner. That's why it lost its market size. Then we can also say the lifetime value of the customer. A particular customer, how much he will buy for his entire lifetime. What are we expecting him to buy? Then financing. Financing is that if the money startup has already raised some money, it has to show how the such money have been invested or how such money has been utilized. If no money has been raised, why it has not raised? Why the other lenders are not willing to invest in a particular business, or why personal finance is not being raised yet? Modes of financing. So first we learned about what are the various ways to review modes to financing. These are two different questions. Okay. Some methods in which a startup firm can bootstrap a start. First one is strict credit. We all know, right? Strict credit means supplier will be giving the credit. Okay, and either be 30 days and down to 90 days. Or otherwise, it can also be negotiable to further more days. Okay. Then this trade credit is helpful so that the working capital needs are quite less as compared without the trade credit. Then the factoring is also we have discussed. Factoring is that where we pledge the accounts receivable or we sell the accounts receivable to get the capital. The process of factoring may actually reduce the other additional cost, because instead of that we would have gone to loan that would have made us to pay the interest cost, which is quite higher. That could be at 15%, but the factoring can happen at 10%. Then factoring is quite cheaper and better alternative. Leasing. Initial days, we will not be able to invest in large machineries. So for the first few years, we may be able to take the particular machinery if it's generally available, not customized. We can take that on lease, and this lease would help us have tax benefits also. Okay, and this also reduces the initial capital cost. So with the additional operating revenue, we'll be able to finance or source the, finance the funds which is required to get that particular machinery on a ownership basis. Okay, then angel investors. Angel investors, though India is full of cultures where we are have the customs of peer-to-peer lending, microfinancing, and so on. This angel investor concept is a very good concept which is being there due to the globalization. Okay, angel investors invest in small startups and entrepreneurs where generally it will be family and friends before, and now it can be other foreign persons even. These person what they do is they give a one-time support, okay, and they will just leave the money, wait for it for some few years, or they can also give the ongoing capital till working capital stabilization is being met. Okay, they give more favorable terms as compared to other lenders, like they invest on equity, right? That's fine. And these angel investors are opposite of venture capitalists. Okay, what are these angel investors called? They are also called as informal investors, angel funders, private investors, seed investors, or business angels. Okay, like they give what we wish, right? So they are called as angel. And then these are affluent individuals who inject capital for startups in exchange for the ownership equity or convertible debt. Convertible debt is nothing but initially we are giving us bond. After a few years, if I wish, if the holder wishes, he can convert the same into equity. Are affluent individuals, okay, who may provide a fund via any type of vehicle. It can be either to come directly or via company or via a trust, something like that. Okay, may whenever they invest, being a one-time investment, it may fail right in the early stages, and they may lose their entire investment. That's why they are looking for some angel professional investors who look for some defined exit strategy, acquisitions, or initial public offerings. Via these, if they're going to invest, they will get some return, right? Venture capital funds. Venture capital funds means an investment vehicle which manages funds of investors seeking to invest in startup firms in small business with exceptional growth potential. So these are expert individuals who manage some funds, okay, like organization funds, trust organization, where the few some non-resident people would invest their capital. This venture capitalist, after detailed analysis of the performance or the performance potential along with growth potential, they will select the firms and invest in those firms. Okay, they finance newly and rapidly growing companies. For example, it can be a Flipkart or Zomato or Amazon or something like that, and they purchase equity securities and they help in the development of new products services, and they add value to the companies to active participation. What are the characteristics? It's for a long time horizon, generally for 3 to 10 years, and then I'm sorry, yeah, lack of liquidity, since they invest on equity, which is for startup, they don't have that liquidity, right? So for that they charge a higher premium. High risk, yeah, it's high risk, high return, right? Then equity participation, generally they take part in the equity, not debt, because via equity they will have the managerial control over the entire startup. Advantages: it's a long-term finance, so you need not have a burden of repaying it in the immediate stretch, and they are going to be business partners. They are going to share both assets and risk and reward equally, and then they're going to give you, since they have a wide global exposure, they will be able to give you good guidance, and then they will also have a network which can be utilized to gain more customers, and then they will also provide additional rounds of funding if they feel that your business is successful, and then they'll also be helping you in the preparing the company for initial IPOs, that their money can be recovered, and they can also help you in the facilitated sale. There are different stages of funding in the VC. we can just go over here. Okay, we'll just complete it here the topic first, and then we'll move on to table. Seed financing is like low level financing, the first just to start to make a prototype. Then startup is like initial marketing and product development expenditure. First round is that first initial sales and manufacturing expenses. Second round is for meeting the working capital, but still the company has not turned profitable. Third round is that now the company is profitable, and now this is known as mezzanine funding. And then fourth round is known as bridge funding, just to go and bridge the company with the public. This is going public process. Okay, yeah. Period of lock is that for seed money it's 7 to 10 years. Extreme risk, because if the prototype fails, the entire business is going to fail. Startup initiating for the okay. First is that for developing the idea itself, and then research phase. Okay, let's understand this as research phase. Startup start developing prototypes and making it successful. First stage is 3 to 7 years. Start commercials and marketing started, and then second stage is start expanding market and growing working capital needed. Though it's not earning enough profit, third stage is that good profits there. Market expansion is our focus. Acquisition and product development is other focus. It's also known as mezzanine financing, as we already discussed. Then fourth stage is known as it's going public. It's just going to bridge ourselves, the company with the public. Is known as bridge financing. This table is quite important because it's already been asked the exam. Okay, that's why it's important. Okay, the years and the this could also be given as a March or something like that, or any way that ICAI can from the question. Then VC investment process. What is the VC process? How they are going to invest in our company? It does have multiple steps. Let's go in detail about it. Each of the steps. Deal origination. We, the chartered accountants, are going to be involved as an intermediary between the VC and the company. Okay. What we do is we do a due diligence report, like we just see the sourcing about the company's sector, what is sales or business focus, what is the promoter's focus, what is the turnover expected. Detailed business plan and business model will be made here. This will be known as investment memorandum. This is an important word here, investment memorandum. So deal origination, it starts with preparation of the investment memorandum. Okay. Screening, we'll just screen whether this will be this will be reviewed. This is like review process by the senior level of people of the VC. They will just check and approve. Due diligence, once it is done, you will appoint some due diligence person, and then to check whether these are actual, and then it will check the evidence that really actual, and they will take the inputs of the due diligence officer, and this fees will also be paid by the VC. So startup doesn't have any expense to be incurred here. Also, deal structuring, once the due diligence is convinced or satisfactory to the VC, then they will start structuring the deal. They will negotiate and arrive at a situation where both parties win-win. Like the promoter will also retain a right to buy back the share. So whenever the VC want to exit, it will say that you promoter has also to be exit, or you have to buy my shares. That's what the condition will be put generally. Post investment activity, once they invest, they appoint, because they have the equity participation, they appoint nominees to the board who will look after the company. They will also set up a committee which is looking after the professional management. Then exit plan will be in two ways. It can either be a sell to third parties. Okay, both you have to sell, or you and I both, the promoter and the VC, will sell to the third party. Or second way is that promoter will be given a buyback. Promoter has to buy back the VC shares at a fixed price. Okay, generally the IRR will be in the range of 18 to 25%, maybe 15 to 30% range. Okay, that would be the IRR, that is internal rate of return. And the buyback is the first step. Like I can bear the risk because my company, right? I have to bear the risk. That's what the principle states. Okay, then how did venture capital funds begin in India? It was initial. It was in the decade of 1970 when government of India has to tackle the issue of inadequate funding with entrepreneurs and startups. But only after 10 years it was successfully implemented with some banks. And then the 1988 the CCI was institutionalized. Then they made this VC to be known as high risky and unattractive, because they have very narrow description. That's why they were not very likely to be involved in investment in India. And then after giving so much of seminars, then we allowed the globalization, LPG policies, globalization and privatization, via which the foreign companies were allowed to invest in India. Then the VC investing got considerably boosted in the IT revolution, and now it's successfully going. How does it form? It is either can be VC can be either be a trust or a company or LLP. Investors could be either a financial institution, bank, pension funds, corporation, or high net worth individuals like Mukesh Ambani or Adani or like that. Then structure of venture capital fund in India. Structure fund of fund in India can be three types. It can be either domestic fund, okay, and two types of offshore funds. The domestic fund is nothing but a domestic vehicle, okay, for pooling of the funds, and separate investment advisor will be there to carry out the due diligence of the asset or right duties of the asset manager. Okay, the pooling vehicle falls between a trust and a company, while trust forms the prevailing due to its operational flexibility. Then we have two types of offshore funds. One is offshore structure and unified structure. Offshore structure is that an investment vehicle makes investment directly into the Indian portfolio companies. Okay, like typically assets are managed by the offshore manager, while the investment advisor in India carries out the due diligence of the identified deals. Okay, that is the funds will be invest. There is a fund. There is a VC fund. They will directly invest in the portfolio companies. In the in the unified structure, the case is different, where domestic investors are expected to participate in the fund. A unified structure is used. Overseas investors pool their assets in an offshore vehicle that invests in a locally managed trust, whereas domestic investors directly contribute to the trust. Okay, trust, right? They will then invest in the fund will invest in trust. The trust will invest in the companies. Venture capital means the funds made available for startup firms and small business with exceptional growth potential. Venture capital is money provided by professionals who, alongside management, invest in young, rapidly growing companies that have potential to develop into significant economic contributors. Then we have the last topic of the day, which is a startup initiative. We'll just go over this one. What is startup to while government scheme is up to 10 days, 10 years from the date of its incorporation. 10 years from the date of its incorporation or registration. It should be incorporated as a private limited company or a partnership firm or a limited liability partnership in India. It cannot be a public company, so be aware. Okay, then turnover for any fiscal year for this entire 10 years cannot exceed 100 crore rupees. Entity should not have been formed by splitting or reconstruction of business which is already in existence. Startup means some new innovation or new ideas, right? So existing business which is splitted up or reconstructed cannot be known as startup. Working towards innovation, development, deployment, or commercialization of a new product or a service or a process driven by technology or intellectual property. This is another criteria just to be fulfilled for a particular company to be known as startup. Okay. So innovative source of funding, yeah, we know it. Pitch presentation, also we know it. Innovative source of funding includes like personal financing, family and friends, personal credit lines, micro loans, vendor financing, right? In pitch presentation, we had the introduction, team. I guess that was the thing. I think. Let's see. Yeah, right. Introduction, team, problem, solution, and so on. With this, we complete this topic even. Thank you so much. If you really like this video, please do share with your friends and subscribe to the channel. Thank you.